So with the traditional IRA, as I mentioned in the previous podcast on investment options for self-employed individuals, you have the ability, if you're not covered by a retirement plan through work, to make a deductible contribution to a traditional IRA. So the maximum this year is $7,000. You put the $7,000 into the account and you take that deduction on your taxes for this year.
Are you ready for a successful retirement? We're addressing the topics facing today's retirees. Welcome to Retire with Ryan. Now here's your host, Ryan Morrissey.
Welcome back. If you're looking to boost your savings through retirement, you might be wondering what's better for you, a Roth IRA or a traditional IRA. So I thought I'd spend some time today talking about the differences between the two. And I sometimes use the analogy that if you were a farmer and you knew that you were going to have a very good harvest, which would you rather pay tax on? The seed or the harvest? And most people answer the seed, right? But there's some flaws in that because you're assuming the tax rates are going to be the same on both the seed and the harvest. And as we know in the US, the more you make, the more your taxes go up. And we also don't know what future tax rates will be, right? Our tax laws are usually put in place and they're only enacted for a certain period of time. In the case of our current tax plan, it's set to expire in 2025, but we have a new administration coming into the White House in January, and they could decide, and they've already said that they plan to change that. So that's where it becomes more difficult to know the answer of whether you should be paying tax on the seed or the harvest. So the Roth IRA is where you're paying tax on the seed, and the traditional IRA is where you're paying tax on the harvest. If we knew what our future tax rates were going to be and they didn't ever change, it would be really easy to make that decision. Probably most people would decide that they want to pay tax on the seed and let the crop grow for a long time, let your investment portfolio grow, and down the road, you would end up having a very nice harvest. But we don't know what future tax rates will be. We also don't know how the harvest will do. We've had a very good stock market over the last roughly 10 years, and a lot of us are used to stocks always going up, and I always hope that's the case. And generally, over the long term, that's always the case, but we don't know what the future will bring. And in certain situations, you might be better off paying tax on the harvest and not paying tax on the seed. So let's talk a little bit more about how a Roth IRA works and also a traditional IRA works, because some of this might not be up to you as far as whether you have the choice to pay tax on the seed or pay tax on the harvest. That might be decided for you by certain IRS requirements. So with the traditional IRA, as I mentioned in the previous podcast on investment options for self-employed individuals, you have the ability, if you're not covered by a retirement plan through work, to make a deductible contribution to a traditional IRA. So the maximum this year is $7,000. You put the $7,000 into the account and you take that deduction on your taxes for this year. Roth IRA also has the same limit of $7,000. And if you're under 50, then it's $6,000 for the Roth or the traditional. But in that case, you're not getting that same $7,000 deduction. However, if you are covered by an employer retirement plan through work, 401k, 403b, 457, even a profit sharing or pension plan, then you are limited to how much your adjusted gross income could be and make that fully deductible $6,000 or $7,000 IRA contribution. As a single filer, your adjusted gross income would have to be under $65,000. And as a married couple filing jointly, it would have to be under $104,000. So if you're over one of those limits and you're covered by a plan through work, then you don't have the option for this year to make a deductible traditional IRA contribution. So then really your only remaining option would be to make the Roth contribution. Now with a Roth account, there is also an AGI limit on that account as well. And as a single filer, your ability to put the full contribution in begins to get reduced at $124,000 of adjusted gross income. And as a joint filer, it begins to get reduced at $196,000. But however, if you find yourself in a situation where your adjusted gross income is higher than that and you still want to make the Roth contribution for this year, there is a way around that, something called the backdoor Roth IRA. What you do is you make a non-deductible IRA contribution, and then you're able to convert that over to a Roth IRA. So essentially, you're making a Roth contribution, but it has to start going into the traditional IRA. So you need to have a traditional IRA as a non-deductible contribution, and then you convert it to a Roth contribution. You want to make the Roth conversion right after you make the non-deductible IRA contribution, because that will minimize any tax you have to pay on the conversion. Where this becomes more difficult is that if you have any IRA monies, then those are counted in the calculation of whether or not this money is taxable when you convert it. And when I say IRAs, I mean if you have a traditional IRA, a simple IRA, or a SEP IRA. Those get aggregated. It's very easy if you have no traditional IRAs in your name, then there's zero calculation on the conversion, so it doesn't cost you any tax to do this. But if you have, let's say, a $100,000 traditional IRA, and you wanted to take advantage of this backdoor Roth conversion, then you have to determine how much of the conversion is taxable. And the way that you would do that is you divide the contribution, assuming, let's say, that you're making a $7,000 contribution divided by the IRA balance of $100,000, and that gives you 7%. So that tells you that only 7% of the conversion would not be taxable. The remaining 93% of the conversion is taxable. So that would get added to your other income to determine your federal tax, and depending on the state that you live in, there could be state tax as well. So that's where it becomes not as advantageous to pursue this strategy. It still could make sense if you don't have any other option to get money into a Roth. And assume, using that example of 93% of the Roth conversion being taxable, then if you were in a 22% tax bracket, federally it would cost you about $1,400 in taxes to get the money into the Roth. But you also have to think about the taxes that you paid to earn the money, because money going into a Roth IRA is money that you've already paid tax on. So using our prior example of a 22% federal tax bracket, you actually earned $89.74 to get the $7,000. I got that number by dividing $7,000 by 0.78, which would be the net amount that you receive. So you'd be paying $1,900 to earn the money, and then you'd also be paying $1,400 to convert it. So if you look at it that way, then you paid almost 47% of the conversion or the contribution, that's $7,000 in taxes. So that's where paying tax on the harvest can sometimes make more sense, or the traditional IRA can make more sense. So how could you eliminate that tax? Well, one way would be to get the money out of an IRA into a 401k. If you have a 401k that you contribute to at work, you could find out if that 401k accepts rollovers, and you could potentially roll over the IRA into your 401k. If you have self-employed income, you qualify to set up a 401k, and you could set up a 401k, and then you could roll that IRA into the 401k. Those are really the only ways that you're going to be able to do this backdoor conversion and not have to pay the tax on it. I should mention earlier that that limit per year, that's $7,000 if you're over 50 to contribute to a traditional IRA or a Roth, or $6,000 if you're under 50, that is combined. So you could decide to put $3,500 into a Roth and maybe $3,500 into a traditional IRA, or $6,000 into a Roth and $1,000 into the traditional. You can decide whichever way you want to use up that $7,000 limit. It just depends on, as we discussed earlier, whether you qualify to take the deduction or you qualify to make the Roth contribution, both based on your adjusted gross income. I should mention that you do have to have earned income to qualify to make either a traditional IRA or a Roth IRA contribution. So what is earned income? That's either W-2 income or self-employed income. If you receive Social Security income or a pension or dividends or interest or annuity payouts, those don't count as qualifying to make contributions into the IRA or the Roth IRA. So there are some differences also regarding these accounts that are worth noting. With the traditional IRA, because the money's going in pre-tax, when the money comes out, it will be taxable to you. So that is one of the reasons why people prefer the Roth IRA. But if you find yourself in a high tax bracket now and you believe you'll be in a lower tax bracket when you retire, it could be more advantageous to take the deduction up front now. And when the money comes out and you pay tax on it, if you're paying it at a lower tax rate than you took the deduction, that's where it makes sense to use the traditional IRA. Also, with the traditional IRA, you have to start taking money out at age 72. So you could let the money grow and defer until that point, but at age 72, there's a certain percentage you have to take out called required minimum distribution. With a Roth IRA, there is no required minimum distribution. You could leave that money in there your entire lifetime, and it's only when a non-spouse beneficiary inherits the IRA that they then have to start taking the money out over 10 years. So if your spouse was the primary beneficiary on your Roth IRA and you predeceased them, then they could take over the Roth IRA, leave it in your name, and then it's only when either your children or grandchildren or a non-spouse inherited the account that they would have to take it out and withdraw the entire account within 10 years. Still, theoretically wouldn't be taxable, but it would have to come out. Now, I say theoretically because you could do a great job saving money in a Roth, getting all this tax-deferred growth, planning on tax-free income, but then our federal government could decide to tax Roth accounts. And it is possible because it used to be that Social Security wasn't taxable. And when we had budget crisis in the 80s, it was decided that that would be partially taxable. So down the road, we do owe a lot of money as a country, and we have a large national debt, large deficit. It is possible that Roth IRAs could be taxable, maybe not at as high of a tax rate as traditional IRAs are taxed, but it is possible. I hope that's not the case. I hope I don't live to see that day, but it is possible. So it might be a good idea as well to diversify your strategy, have some money in Roths, have some in traditional, and that way you have choices as far as how you take the money out and how you decide to spend the money. And also in certain tax years, it could be more advantageous to take money out of one versus the other, depending on what your taxable income looked like that year. Ideally, what you'd want to do in most years is you'd want to fill up those lower tax brackets. Currently, the lowest tax bracket is 10%, then the next highest is 12%, and then it goes up to 22%. And by doing that, that way you're utilizing paying tax at the lowest rates. If you don't take any money out of your traditional IRA until you reach 72, and you're not filling up these lower income brackets, then you might end up paying higher tax when you're forced to start taking the money out because your distributions could be higher at that point. I should point out too that another nice benefit of the Roth IRA is that at any point you can take out your contributions penalty-free, no matter what your age. To take out the gains in a Roth IRA, you have to wait until you're 59 and a half. You also have to have the account open for 5 years. Similar to a traditional IRA, you have to wait until 59 and a half to take any money out of the account, or you pay a 10% penalty on top of the income tax. There are a few exclusions to this 10% rule that you may qualify for. So I would say if you're younger and you find yourself in a lower tax bracket, that's where the Roth IRA is going to be more advantageous, as you're paying tax at a low rate to get the money into the Roth, and you're also giving yourself more time for the money to grow. The closer you get to retiring and the higher tax bracket you get into, that's where the traditional IRA could make more sense, because you could wind up in a lower tax bracket in retirement because your income will be lower. I hope you found this episode helpful on understanding the differences between a traditional and a Roth IRA. If you're enjoying these podcasts, please subscribe and also leave a review on iTunes or your favorite podcast app. And I look forward in the new year to bringing some more exciting topics to you, as well as bringing on some guests. I wish you a happy and safe 2021, and I look forward to talking to you in the new year. Take care.
You should consult a financial advisor familiar with your specific circumstances before you make any financial decisions. Nothing in this broadcast constitutes a solicitation for the sale or purchase of any securities. Any mention of rates of return are historical or hypothetical in nature and are not a guarantee of future returns. Ryan Morrissey, CFP, is an investment advisor representative of Morrissey Wealth Management, LLC, a registered investment advisor.